Today I'm revealing the 7 things that all institutional investors look for in your business, and if you're missing even one of these, your raise is absolutely dead in the water. And we know what these guys are looking for because we've personally worked with hundreds of companies to raise more than $37 billion in institutional capital, and we've sat in rooms with VCs, private equity firms, family offices who've deployed billions of dollars. So I'll be breaking down each one with real examples from deals that either we've worked on or ones we've seen within our syndicate. By the end of this video, you'll know exactly what these investors are looking for, how to demonstrate it, and how to position your business to actually get funded. Let's dive in. Here are the first 4 investor must-haves. Number 1, they need to know exactly what you're going to do with their money. You'd be surprised how many founders show up with a round-sized $10 million raise, but zero operational clarity on where it's actually going. I recently worked with a company raising $20 million. Their initial deck said growth and product. When we drilled down, that meant hiring, maybe an agency, maybe expanding into Europe. Vague. We rebuilt their slide, $6 million into customer acquisition, $4 million into product development, $10 million runway to Series B. Once we reframed it, 2 funds moved forward in 2 weeks. So key takeaways. If investors don't see a line-by-line deployment plan, they won't see ROI. Okay, proof of traction, metrics that match your ask. Traction is relative to stage. Pre-seed might be team plus prototype. Series A better show revenue. For instance, one fintech startup we helped show just 100,000 MRR seemed light, but we showcased CAC payback in 3 months, 92% logo retention, pipeline of 1.2 million. That quality of traction, not just top line revenue, is what closed their $7 million round. So key takeaway, show traction is aligned to your raise size. So if you're asking for 20 million, show why you're ready to deploy 20 million. Number 3, market timing and urgency. Investors look for momentum markets. You can have the perfect team and product, but if your space feels cold, good luck. A climate tech company we advise had a decent product, but what moved the needle? They mapped their raise to new ESG reporting mandates, IRA tax credits, and timely carbon offsets demand. They made the timing non-optional for investors, and that urgency led to a bidding war. So key takeaway, link your raise to a microwave or market pressure. Money chases heat. Number 4, team legitimacy. Now this one's obvious, but most founders don't position it right. We worked with a logistics SaaS founder who wasn't a big name, but he'd built route optimization software for FedEx. So we led with that, built the exact system you're disrupting. He raised $6 million pre-seed with just a deck and a 3-person team. So key takeaway, your bio isn't a resume. It's a reason to trust the vision. So really quickly, if this has been helpful so far, I put together a free checklist as usual that breaks down each of these 7 investor priorities and exactly how to position your business for each one. So it's perfect if you're prepping a raise right now or even just pressure testing your strategy. So check the first link in the description below, 100% free. If you don't need it, no sweat, no hard feelings. So let's keep going. Okay, final 3 investor must-haves. Number 5, institutional fit. Now this is the quiet filter. Do you even match their mandate? How many times do we have to say this on this channel? I once helped a company pitching a $25 million Series B to a fund whose sweet spot was $5 to $10 million checks. Waste of time. Investors have filters: stage, geography, sector, ownership, target, exit, horizon. So the key takeaway is if you don't match their investor thesis, nothing else matters. Don't even bother. Number 6, moat or competitive edge. No moat, no money. But moats aren't always patents or tech. Sometimes it's data advantage, distribution model, speed to market. One marketplace I worked with had dozens of small competitors, but they had a 6-month exclusivity with 3 anchor clients, plus an API inside their SaaS toolset. We called it an execution moat, and that made it fundable. So the key takeaway is show what makes you defensible, not just different. Number 7, path to liquidity. Now this is the big one nobody talks about. Every investor, no matter how long-term, eventually asks, how do I get my money back? That doesn't mean having a detailed exit plan, but it does mean M&A dynamics, public comps, secondary markets, buyback potential. We worked with a founder who showed 3 potential buyers in the next 24 months, complete with relationships. Now that clarity accelerated diligence dramatically. So the key takeaway is this: investors fund outcomes. You got to paint the path to the desired outcome. Now, one thing that institutional investors will be looking for is a good pitch deck. The thing is, if you haven't gotten any professional advice on your deck, you might have made some killer mistakes without even knowing it that you won't even survive without fixing them. So click here to check out the next video where I go over key pitch deck mistakes that you need to avoid if you actually want to get presentations to go well, and what you need to do if you want to successfully complete your raise properly. So we'll see you over there.